Welcome back to KTM Investing. Before we get into the video, we wanted to say a special thank you to our subscribers. We really appreciate your support. In the world of investing, knowledge is power. The more you understand the tools and metrics available, the better equipped you are to make informed decisions. One powerful tool in your investing arsenal is the price-to-earnings ratio, often called the PE ratio. This metric is widely used by investors to evaluate the relative value of a company's shares. It's a simple measure that can tell you a lot about a company's stock valuation. By understanding the PE ratio, you can get a quick sense of whether a stock is potentially overvalued or undervalued. Think of it as a quick way to gauge if a stock is potentially a great deal or is too expensive. This can be particularly useful when comparing companies within the same industry. The PE ratio is calculated by dividing a company's current share price by its earnings per share, or EPS. This formula provides a snapshot of what the market is willing to pay for a company's earnings. Earnings per share are the company's profits divided by the number of outstanding shares. This figure is crucial as it represents the portion of a company's profit allocated to each outstanding share of common stock. This ratio essentially tells you how much investors are willing to pay for each dollar of a company's earnings. A higher PE ratio might indicate that the market expects future growth, while a lower PE could suggest the stock is undervalued. Let's look at an example to make this clearer. Imagine Apple is trading at $150 per share. This is the current market price of one share of Apple stock. Let's say their earnings per share over the past year were $6. This means that for every share of Apple stock, the company earned $6 in profit. To calculate Apple's PE ratio, you would divide the share price, $150, by the earnings per share, $6. This simple division gives you the PE ratio. This gives you a PE ratio of 25. In other words, investors are willing to pay $25 for every $1 of Apple's earnings. This means that investors are willing to pay $25 for every $1 of Apple's earnings, which can fluctuate from day to day, regardless if Apple sales actually improve or not. A PE ratio of 25 can be compared to other companies to assess relative value. Understanding the PE ratio is a fundamental step in making informed investment decisions. It helps you to quickly assess the market's expectations of a company's future performance. It's a key piece of information that can guide you toward undervalued companies and help you avoid potential investment traps. By mastering this ratio, you can enhance your investment strategy and make smarter choices. Now, it's important to remember that PE ratios can vary significantly between different sectors. For example, technology companies often have higher PE ratios compared to utility companies. This is because investors expect higher growth from tech companies, so always compare PE ratios within the same sector to get a more accurate picture. Forward PE is another useful metric that investors often rely on. It uses projected earnings over the next 12 months instead of historical earnings, providing a forward-looking perspective. This can give you a better idea of a company's future performance and potential growth. But, keep in mind, projections can be optimistic or based on assumptions that may not materialize, leading to potential risks. It's wise to look at a range of analyst projections and consider the company's growth potential as well as market conditions. When it comes to entry strategies, buying stocks with a low PE ratio might seem like a good deal, as it suggests the stock is undervalued. However, a low PE could also indicate underlying problems within the company, such as declining earnings or poor management. On the other hand, a high PE ratio might suggest overvaluation, meaning the stock price is higher than its actual worth. It's crucial to do your homework and not rely solely on PE ratios. Look at other financial metrics such as debt levels and cash flow, and understand the company's business model before making any investment decisions. Well, that is all we are going to cover today. Don't forget to subscribe to KTM Investing for more analysis and insights. We appreciate your support, thank you for watching, and we will see you in the next video.